ለመማር ወደ ትምህርት ተቋም መሄድ ግድ አይደለም። ናሽናል አቪዬሽን ኮሌጅ
ራሳችሁን ከኮሮና ቫይረስ ወረርሽኝ እየጠበቃችሁ በቤታችሁ ወይም በተመቻችሁ ቦታ በኢንተርኔት አማካኝነት በኦንላይን ትምህርታችሁን መከታተል ትችላላችሁ።
ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና ከእንግሊዙ ኢንስቲትዩት ኦፍ ኮመርሻል ማኔጅመንት ICM ጋር በመተባበር የሚሰጡ ትምህርቶችን ተከታትላችሁ በ6 ወር ጊዜ በዓለም አቀፍ ደረጃ ተቀባይነት ያለውን የስልጠና ማስረጃ ባለቤት መሆን ይቻላል።
ልምድ ባላቸው መምህራን እየተማራችሁ ጥያቄና መልስ፣ የክፍል ስራዎች፣ ፈተና መፈተን ክፍል ውስጥ እንዳላችሁት አይነት በኦንላይን ባላችሁበት ቦታ ከናሽናል አቪዬሽን ኮሌጅ
የናሽናል ኤርዌይስ እህት ኩባንያ
That is assignment 2, and it has 2 questions. Question 1 is actually addressing the issues we discussed last week, and we did illustrations to explain that, how we go about that. Then the question 2 is going to address actually what we started yesterday. The application of CAPM so that we come up with the optimal portfolios. We are to go through an illustration just to explain how we apply this model. We also looked at the different security lines, like the capital market line, the security market line, all right? We saw their purpose. Basically, capital market line deals with portfolios, and security market line deals with the single individual projects that form the portfolio, so we can determine the risk as well as the returns of individual portfolios with a combination of a number of securities. We have the risk-free securities, and then we have also the other securities or the market securities. So I just want us to go through the illustration so that we can probably understand how this model is applied in terms of evaluating projects to come up with the optimal projects that can form an optimal portfolio. So we also agreed from next week, that is on Friday, next week, we are going to have presentations. And I think each one of you is already prepared with the areas that will come up with a presentation that you're going to do as from Friday. But I would request, before we meet as a class, you share the presentation to my email. I think all of you have my email. Probably I can put it on the chat so that you share the presentation on my email prior to the class, so that I'll be able to go through it and pinpoint areas that need to be clarified or the gaps that needs to be filled as do your presentation. So it's actually important that you share your presentation before the class so that I can also have time to go through it prior to that of class. So you can get my email address on the chat, group chat. You can see that I've already typed rodunga2@gmail.com. So everybody, I think we need to be prepared, all of us, from the word go, so that in case any of us is unable to join for one reason or the other, then we can have the rest do their presentation. those topics are independent, though they are important. As I said from the beginning, that it's not just about evaluating projects to decide to invest in, but because we cannot work in to interact with the market, and therefore we must understand the market. We must understand our environment, the environment we are operating in. We must understand the market so that if we are to make any decisions, then we should be informed about the market, and the decisions that you're making are and many other factors. We have to deal with the market, whichever way. So it is paramount that we understand the market we are operating in so that we make informed decisions. So the areas I gave you to look into are basically going to build up the basics that we require for us to make informed decisions, other than the technical areas which we are handling now, and which are actually combined with the relevant information that we require, or factors that may also affect the decisions that we make as managers. All right, so allow me to share the presentation so that we pick up from where we left last week. Yesterday, sorry. And we had discussed, we had seen the basic equations. We looked at the illustration on to determine whether we can, a security is overvalued or undervalued, and which line do we use to determine that? The capital market line. So the capital market line helps us identify securities or projects that are overvalued, portfolios, and those ones that are undervalued, and those ones that are greatly valued, so that we take advantage. We take advantage of the situation that is in the market, probably to the benefit of the organization. Like when do we sell, when do we purchase, all right? And in the course of doing that, we actually aim at maximizing the returns and, of course, reducing the risks. We also looked at the efficient frontier curve, how to come up with an efficient portfolio. We have a number of scenarios, and it all depends on the risk attitude of the investor. So we have the risk-averse investors, we have the risk takers, and always risky projects are always associated with the high returns, unlike the less risky projects. So we have to evaluate both sides. And we finally agreed that for decision-making purposes, projects that are lying above the efficient frontier line are actually optimal projects, and projects that are lying below, they are dormant projects, so they are not optimal enough. And the same correlates with what we saw with the capital market line. Projects that are lying above the capital market line, those are undervalued projects, and that's the time to purchase. And the ones that are falling below the CMA line, the capital market line, those ones are inferior projects, and therefore, they are overvalued. And when they are overvalued, that's the time to sell, so that we make gains because of that, the happenings in the market, in the current market. So those are some of the issues you encounter as you look into some of these models, other than the normal portfolio model that actually will help us internalize some of these things we are talking about, and which you can also make use as you do. Okay, we had given the questions for both SML and the CML And the only difference is CML looks at a portfolio in nature, and while this one looks at individual projects. And there are also other differences which we shall look at as we continue. Now, ABC has a total capital of 360 million. Assume these are pounds, or I mean dollars, not shillings, invested in 3 stocks as below. So we have the stocks beta coefficient, and these are the millions, the amounts that are invested in each of the projects. We have project A, B, C, and the total amount of the investment is 360 million. So this is a combination. This is a portfolio, right? This is a portfolio, and it's a portfolio of projects A, B, C, and they have various combinations, all right? Like you can easily determine how much of B is the total investment, as well as how much of C is the total investment. So beta coefficient is the same as the standard deviation as we are used to, all right? But because we are dealing with the market, then we use the beta coefficient, and which represents actually the standard deviation or the risk of that investment. So using CAPM and assuming that risk-free rate is 5% and expected return in the market is 9%, you are asked to calculate the following, all right? So we are given the risk-free rate, which is at 5%. The return in the market is 9%, just like what we are looking at yesterday. So if you are to go by that, then assuming we take this, so allow me just to have this in the I hope you are seeing the slides. Are we?
Not missing.
You are not.
Where is?
Not telling me. You're not telling me that you're not seeing that. I don't remember sharing that. Okay. See?
Yes. No.
Are you seeing the screen now?
Yes. Yes. Now it is visible.
So I'm talking about this illustration.
ABC has total capital of.
Has a total capital of 3 million. Good. Yes. So we have the stocks beta, we have ABC, and we have the combination, the proportions, the proportions of each one of them in the portfolio. So as I was saying, the stocks beta represents the deviation, the risk, or the standard deviation as we are used to. So this is the risk of each of the project in terms of the investment that we are putting. And you realize here we don't have probabilities, we don't have, and assuming that risk-free rate is 5% and expected return in the market is 9%. So you're asked to calculate the following. So we have the, okay, so we have the RF, we've been told is 5%. The RM is 9%. And then the proportions are 160M, 120M, 8M, and then the data is 5, 0.5, 2.0, 4.0. So you realize the risk, these are risks. That's why it's not, it doesn't have to add up to 1, just like the probabilities, but these are risks. So risk can be any number. So we have project A, B, and C. So A, the proportion of A is 160. M of B is 120. M of C is 80. M and total is 360 M. Right, then we have the beta factor. The beta factor of A is 0.5. Uh, 2.0 and 4.0. So we also told that our RF is equals to 5%. And then RM, that's the return in the market, is equals to 9%. So that's the information you've been given. But then we are asked to determine the return. Okay, we are asked to determine the expected return of each stock. The expected return of each stock. So if you recall, which formula are we using? Return of each stock, then we have to apply the SML formula. Okay. So this formula here, so A return of each stock. So RJ is equals to RF plus DJ into RM minus RF. Any question? You okay? So can you substitute into this and tell us the RJ? So this is equals to, for project A, RF is 5 plus DJ is 0.5. Okay, 0.5. Into 9 minus 5. What do you get? What do you
9.5.
get?
9.5%.
9.5?
Percent.
9.5%.
Yeah.
Any other different answer? How comes I'm getting 7%?
Wait.
Hmm?
Wait. Boy. 2. No, 7%. 7%. 7.
Huh?
7%.
7%.
Yeah.
How did you get 9? Michelle, 0.5.
First by adding of the 2. 0.5 times 4. Is that 2?
4, but you see, you're halving it by multiplying by 0.5. Remember, I said you have to observe the BODMAS rule.
Yes.
When you have brackets, you open the brackets first and then followed by multiplication. So you open the bracket, that is 4, multiply by 0.5. It gives you 2. So
2 plus 5?
to 5.
7.
That is 7. Yes. Okay. You have to be careful when you have a mixture of this. And there's always a rule that you follow that I get right. Anybody else with a question? Okay. For project B, can you work out for project B? What is the expected return for B? Emebet, can you work out that and give us the return for B?
Okay, doctor.
That 13?
13?
I think so.
You're getting 13%?
Yeah.
Okay. Emebet, what are you getting? Emebet, what are you getting? It's just the same procedure, all right? Risk-free will remain the same, plus the beta of B is 2 into 9 minus 5. So that would give us 8 plus 5, yes, which is 13. So the answer is 13. How about RC?
RC is 21.
Return of project C. So is 5 plus 4 into 9 minus 5. So that is 4 times 4 is 16,
21.
plus 5 is 21.
Yes.
21%. So these are now the expected returns for the projects. Okay. That's part A of the question. You remember, we are being asked to calculate the returns for each project. So when it's each project, then we apply the SML equation, which you have written up there. But if it's for a portfolio, then you apply the CML equation. Right? This is SML, as we saw from our discussion. Any question? Okay, but B, expected return for ABC investment fund portfolio. So this, if you have each of the projects invested, expected returns, like you've computed here, what do you do to get the portfolio's return? Now applying the same concept we discussed last week. Who can give us? How do you determine the return of the portfolio if you have the return of individual projects? Girma, what do you think?
Yes, sir.
What do you think?
I think it is a combination of the individual portfolio assets, so you have to add them.
You have to? I gave you that formula to determine the portfolio's return. Okay, so RP, if you can recall this formula, return of portfolio is equal to return of A times weight of A plus return of B times weight of B plus return of A return of C times weight of C. Okay. So you already have return for A, which is 7%, for B is 13%, for C is 21%. You can compute the weights, isn't it? How do you determine the weight? For A, for example. How do you determine the weight for A? It's 7 times 160 over 360. Where is this one coming from? Plus 13 into 120 over 360. Plus 21 into 8 over 360. Are we together?
Yes.
Any question?
No.
So if you want to know, like our total investment is 360. Our total investment is 360, and each of the projects is taking this proportion. So you can easily get the proportion of this into this by dividing. But then we know the return, so we multiply with the returns to get our and we add to get our total return for the portfolio. So can you work out this and give me the answer?
በትምህርት ከፍ ብሎ መብረር ይቻላል። ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ከከፍተኛ ትምህርት አግባብነትና ጥራት ኤጀንሲ ሙሉ ዕውቅናን ባገኘንባቸው በማስተርስ ዲግሪ ኤምቢኤ በስትራቴጂክ ማኔጅመንት፣ ኤምቢኤ በባንኪንግ እና ፋይናንስ፣ ኤምቢኤ በቢዝነስ ሊደርሺፕ፣ ኤምቢኤ በሪስክና ኢንሹራንስ፣ ኤምኤስሲ በኢንተርናሽናል ትሬድ እና ኢኮኖሚክስ ዘርፎች በእውቀት ለመቅረጽ የበቁ ፕሮፌሰሮቻችን አረንጓዴ መብራታቸውን አብርተዋል። በነገራችን ላይ በኬንያ ሀገር ከሚገኙ ስመጥር ዩኒቨርሲቲዎች በሚመጡ ፕሮፌሰሮች የትኩረት መስክ ትምህርቶቹ መሰጠታቸው ልዩ ያደርገናል። በምርጥ የትምህርት ስርዓት የተገነባው ናሽናል አቪዬሽን ኮሌጅ በመጀመሪያ ዲግሪ በአቪዬሽን ማኔጅመንት፣ በሆቴል ማኔጅመንት፣ በአካውንቲንግና ፋይናንስ፣ በማርኬቲንግ ማኔጅመንት አስተማማኝ ትምህርት ይገቢውና ራስዎንና ሀገሮን ይለውጡ። አድራሻ 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ። ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ህልሞን እውን ያደርጋል።
Anybody with the answer?
12.11.
12.11. Percent. Anybody else with a different answer? Emabet, what are you getting? Emabet.
እመቤት እሙ ኧረ ጠፋሽበት።
What are you getting?
አገኘሽ መልስ? ሙት አድርጊው።
Okay, let's say check. But you have to work out this first. Work out this first. Work out this first, and then you add.
Okay.
Yeah. I hope that's what you did. Let's just confirm. Say 12.009. 12.009. And you're getting 12.11. When you work out this, what do you get?
Which one? The first one. 3.11.
160 I. Yes. 11. All right.
No, 3.11.
Okay.
3.11.
Second one.
4.33. 4.33.
4.33. Then the last one.
4.6666. 4.666. So we make it 4.67.
Okay. 4.67.
7.
So when you add, so you're right. So this is okay. That's okay. So that is what you ought to have done to determine your return for the portfolio. Okay, so this is okay. So that is what you should have gotten as your return for the portfolio. Then any question before we look at the risk of the portfolio? Okay, so let's see if we are to determine the risk of the portfolio. ABC investment fund portfolio beta. Okay. All right. Portfolio beta. It is now, as we are told from here, you can see there is this formula. The beta of portfolio is given as this: weight of A, beta of A plus weight of B, beta of B plus weight of C, beta of C. So the same applies here. It's not like what you were doing the other time. So portfolio beta is equals to weight of A, beta of A plus weight of B, beta of B plus weight of C, beta of C. All right, so betas we already have here. So we have 0.5 for A into 160 divided by 360 plus beta of B is 2.0 into 120 divided by 360 plus beta of C, which is 4.0 into 80 divided by 360. So what do you get? If you work out that,
1.777.
1.777.
777. Yeah, 7. Again 7.
The next one is 7 after 7.
8.
Is that so? Huh? So that we round it off to 8.
Yeah.
Is that correct, Irma?
Ame.
Is it adding up to
عارف
that?
المفكر كنت
እሺ አንድ 7 ይላል። 8 መጨረሻ
Okay.
እንደዚህ
Is that correct?
Yes, doctor, it's correct.
It's correct, huh?
Yeah. So,
Good.
Yes, it's right. I think.
1.776.
can see.
The last figure, is it 6 or 7?
Hmm?
The whole thing, is it coming to 1.7777 continuous?
Yes.
Any. The last one is 8.
So when you round it off, it's 8. Huh?
Mm.
Fine. So that is what is actually what was expected of you in terms of this question. You realize that you require this knowledge to handle the question 2. And you need also to have the knowledge of whatever we did last week, that you're able to come up with right figures to feed in the formula that you may have, so that you determine the right returns and the risk that you are asked to compute. All right, any question?
No.
So you need to do more practice in this area so that you're able to address some of these questions in this, if in case you come across some questions. We continue with our discussion. So we are saying we have differences between the 2 lines that we saw yesterday, the capital market line and the security market line. Just as we have mentioned when you're going through the illustration, we said the CML is a line that is used to show the rates of return, which depends on risk-free rates of return and levels of risk for a specific portfolio. So when you talk of these lines, then we must have a portfolio that includes the risk-free asset. And we can give examples of risk-free assets, treasury bills, bonds, and all that. So the SML is a graphical representation of the market's risk and return at a given time. But these are for individual portfolios, individual securities. While standard deviation is the measure of risk in a capital market line, beta coefficient determines the risk factors of the SML. So standard deviation, when it comes to CML, we use standard deviation. But when it comes to SML, we use beta factor, just like what you've been doing. You've been using beta. And that represents actually the risk that is attached to any particular security that you invest in. Now, next, while the capital line or the CML graphs define efficient portfolios, security market line graphs define both efficient and non-efficient portfolios. Okay, so as we saw, practically when you are looking at the CML line, you're able to identify the efficient portfolios, and it's actually like the efficient portfolio, efficient frontier curve, all right? Only that in the SML, we have risk-free assets within the combination, and therefore, that's why it differs from the efficient frontier line. So we are looking at the differences between these 2 lines.
Okay.
We are saying there are some differences in the way we look at them and the way we can make use of them. So where the market portfolio and risk-free assets are determined by the security market line, all security factors are determined by the SML. Actually, SML is a component of the capital market line, because SML as an equation can be used for individual assets, but CML is used for portfolio, which is a combination of a number of assets. Then we have weaknesses of portfolio theory. Portfolio theory is what we saw last time, and we did the risk-return trade-off, and we were able to evaluate projects based on the risk and return, as we saw yesterday. It has, as a model, it has its own limitations. Most models have weaknesses depending on how you look at them, because the assumptions may not hold in some circumstances. But for the model to work or to be useful, then we have to hold some factors constant, despite the fact that they may not be really applicable in a real situation. So, okay, so what you are saying is, as a model, like any other, it has limitations or its weaknesses. And it's good to know some of the weaknesses of this model because it's widely used anyway, and it has helped managers evaluate projects and come up with the optimal decisions that actually help them select projects that are viable and actually optimal for the organization. So it considers total risk, which is business risk, as measured by standard deviation of a portfolio. However, some risk is diversified once a portfolio is formed. Okay, so a portfolio once formed, the essence of a portfolio is actually to diversify risk. So for us to achieve this, we have to come up with portfolios that actually will help us manage risk or try to diversify risk so that we benefit, we make returns in projects that we may be selecting from our portfolio. Now, it uses historical data in analyzing portfolios, and the probabilities used are subjectively determined. Okay? You know, there's no basis of determining a probability. And as we know, probability can be between 0 and 1. All right? So how do you come up with a probability? It's just probably out of the historical data that you have analyzed, and then you can project based on the historical data that you have. So it's actually based on the history that we have about the securities, and probably looking at the market, the environment, so that because these variables keep on changing and fluctuating with time, so they may end up affecting the performance of a certain security in the market. So probabilities are actually we come up with the probabilities based on the past history or past data, that information that we have about the securities performance. That may not be realistic. That's why we are saying it's subjective, and it's bound to change with changes in the environment. Then next, it assumes that there are no economic of scale, hence there are no extra returns derived from combinations of projects. Again, you see the returns. The expected returns are not actually the same. That's why we have to compute the standard deviation. So you realize that the actual returns may differ from the expected returns, and therefore there is need to compute the deviations, which are actually represented by the risk that we can allocate to a particular investment or project. So so these are the returns. We can get more or less than what is expected, and that is actually what happens in the market, because returns are also determined by so many factors: issues of inflation, issues of interest rates, issues of demand and supply. All these economic variables may change the direction of returns than what was expected. The use of indifferent curves is not practical in the real world, in determining the investor's utility. They are too theoretical, right? Utilities, different people have different levels of utility. And how do you come up with the optimal utility? So it's an issue of trying to imagine the most appropriate levels of utility. With this, variables are bound to change, and they may not actually behave the same way like we anticipated due to changes in the economic variables and all these factors. It ignores the risk of bankruptcy which investors face when they borrow in order to make investments. All right, we may evaluate projects and we may keep certain factors constant, but they may not come out to be the same as things like systematic risk, market risk that may affect investments across or in the market generally. So you may find that such things may render investment to a whole, isn't it? So that it doesn't work out as anticipated. Things like war, like this political violence. When you find you put your money in an investment somewhere, and you find things cannot work, there's violence, you cannot even access your investment. So you find that is a sunk investment. So, and assuming you had borrowed money, so issues of bankruptcy can come about, or being thrown out of the business due to unexpected factors. So those are things that are about to happen, and they may not always work within the anticipated circumstances as an investor may have. Again, it assumes that investors are risk averse, but in reality, it's only managers who are risk averse, while shareholders are not, since they own multiple investments to form a well-diversified portfolio. All right. This is so typical of it because we are saying managers, because of these agents' issues, they are also very sensitive about risk, because as much as they are making decisions for the shareholders, then they have also to be careful that whatever investment they are, putting up, have minimal risk as much as possible to safeguard their interest and the interest of the shareholders. But shareholders may have their own portfolios where they are putting their money in several companies in terms of shares, assuming you are buying shares of several companies. So it's now, investors who are the managers may typically be risk averse, but now the shareholders themselves may not have that concept in mind. They just buy shares all along, but now it's the duty of the managers who are now the agents of the shareholders who are doing the real work and who are really the parties that are risk averse, because they are doing it on behalf of the shareholders. The market portfolio is a theoretical portfolio since it cannot represent all private and listed companies in the stock exchange. For example, the 20 companies which constitute Nairobi Securities Exchange or Index cannot represent all companies in Kenya. Um, not easily be accessible. And because of the information availability, we tend to use the stock exchange index to represent the performance of companies in that economy. And it's a variable that's used to determine many other factors like the economic growth and all these, the FDI's investment in the local economy, the foreign investors in the local economy, and many other factors. But you realize that it does not really represent whatever is working in the background, like the private companies which are not listed. All right. So this one is just serving as an indicator because of the information about these companies, their tradings, their shares, prices are easily, accessible and determined through many other means like forces of demand and supply. So you find these companies their performance becomes the index that can be applied across. But in the real state, in the real sense, they are not actually the actual index. It could be more, it could be less, but this is just an indicator. So that's a weakness, because if everything was to be done, then we would have looked at all companies, including the private and all other companies that are operating within that economy, to come up with the index, the performance index of these companies. But you realize that that is not economically viable because of accessibility to information. It would be too costly. The cost-benefit analysis does not allow that. So you rather just come up with an indicator that can serve for all and which can be used as a basis to apply to others that are not, whose information may not be easily accessible. Now, portfolio theory assumes that the projects are divisible. However, in reality, some may be indivisible. Now, you see, not all and which is the assumption of the portfolio theory. You can have projects, all right, and a project or one project, and you can divide it into shares, like 1,000 shares. You can decide to dispose of like a half of it and retain a half. So that's, you are dividing your shares into half, isn't it? Or you can decide to sell off part of your shares holding and retain part of it, or even dispose everything. Or you can buy part of the shares of a company and not buy all the shares of that company. So that is the divisibility we are talking about. But there are some cases where some assets may not be divisible. But there are those other assets. So like, for example, if you're talking of physical assets, it may not be easy to divide that and dispose part of it and retain part of it so that you continue owning that. So if you have to dispose it off, then you are disposing it of everything. If you have to purchase, you have to purchase everything. And such assets may always require huge outlay in terms of purchasing, as opposed to these ones that are divisible, where you can just buy whatever you afford and with the limited resources that you have at that particular time. And because the shares are divisible or the securities are divisible, so you can acquire the portion that you afford at any given time. Disposing of, you can dispose of part of your ownership depending on the need at that particular time. Okay, so that's investments projects. There are projects that cannot be divisible, like assuming it's a machinery and you want to buy, you cannot buy part of a machinery because it's a whole combination of a complex machine that has to work self-interrelated, you know. It's running itself. You cannot buy in pieces the investments you're talking about. And if you have to dispose it off, then you have to any question on these limitations of portfolio theory? Hello, guys there?
Yes.
Do you have any question?
No question. No question, Doctor. It was clear.
Okay. All right. Lastly, CAPM, capital asset pricing model. One we started with, where we had the determination of the risk of an individual asset, the return of an individual asset, and then of a portfolio, all right, and the risk of a portfolio, and then where we had to determine the correlation coefficient and all that. That is the portfolio theory by Markowitz, and which is the father of all these theories. CAPM is actually another model that came after the Markowitz theory, and it actually builds on that, because now it brings in the element of risk-free assets and the market risk, market risk, and which is systematic, because as we say, as an organization, we don't operate in isolation. We have to operate with the market or within the market, and therefore there are certain issues that we have also to be concerned about as much as we are evaluating the projects. Now, CAPM has its also limitations, all right, and one of them is it is widely used concept. Some okay, but assumptions can be met in the real markets conditions. So some assumptions can't be met in the real conditions. When we are talking about limitations, we are actually focusing on the assumptions, because for a model to operate, there are certain assumptions that have to be held. And these assumptions are the ones that we try to criticize if you have to point out some of the limitations. So one, for CAPM, real markets have transaction assumptions of CAPM. If you recall that, we saw that yesterday. One of the assumptions is that there are no transaction costs in the market. Have transaction costs, all right? In a real typical market, we cannot miss that. So of transaction costs, moreover, they can differ. Institutional investors have lower transaction costs than other investors. Institutional investors normally have a huge kind of investment because of they use scales of economies. You know, when you have when you buy in terms of costs and institutional investors actually their costs may differ from the individual investor. You tend to income more because of relatively more some other factors. And the smaller units you buy, your unit, the number of units you're buying. Several taxes are present on investment capital, e.g. capital gains tax and the economic utility, the efficiency of investments, and affect the pricing of assets. You know, tax is an element that affects price directly because once the taxes increase, the price tends to increase accordingly because of the tax element. So all right, but indirectly they're taxed, so we cannot have completely no taxes. In an efficient investment, they should be taxed because pricing, tax has an element in the pricing. It's a contributing element in the pricing of an asset. Apart from the profit that probably the seller may be aiming at getting. So you find taxation is a variable that cannot be ruled out completely. And even if it's not directly there, you find it's indirectly there. Real markets are not always efficient, so investors do not have homogeneous efficient markets. And one of the topics one of you is going to present on is about the market hypothesis, efficient market hypothesis. We cannot have an efficient market completely. This assumption does not hold. I mean, it's in a real situation cannot work. There must be information, those who are privileged to have certain information, and not all participants in the market will have the same information. If you are a manager, then you tend to have more information because you've been keen and following up on the occurrences in the market. So you are also having information from inside the organization that probably you are managing. So you tend to have more information than just an investor who is coming out to invest, to buy shares of that company. So information that the participants may have, and that actually has an effect on the pricing of the securities or projects in the market. Now, no asset is free of risk. Even treasury bills are exposed to inflation risk, liquidity risk, and investment risk.
ታምሩ
ወይ
ምንድን እየተሰማኝ አይደለም።
ሁላችንም እየተሰማን አይደለም። እባክሽ ስራ ይዘናል።
ዘና ፖስት አድርጎኝ ወጥቷል ደግሞ በሪውን
ምን ነው ሄሎ ሄሎ
ምንም እየተሰማኝ አይደለም። ቢበቃን አሪፍ ነው አለ ዛሬ አይበቃም? በቅዳሜ ቀን እስኪ በለው በእናትህ
ምን አለበት ቅዳሜ ምናምን
ኔትወርክ ያስቸገረን።
Hello?
Yes, sir. Yes, sir.
Are you able to see the screen?
Yeah.
You can read the screen?
No.
Huh?
بس ترفع Tommy. Hello, Tommy. Nandang mo ito? Tommy.
ቼክ ታደርጓለህ? ከዚሁ
Tommy. Tommy. What on?
Hello. Hello, Tommy.
Say it. Tommy.
Doctor.
Hello?
Hello, doctor.
Yes, yes. You can see me? You can hear me?
Yeah, I think there is a network problem.
Yeah. You can see the screen?
Yeah.
All right. I was just finalizing on this. We are actually looking at the limitations of CAPEM. And you are saying investors have different abilities to borrow at a risk-free rate. For institutional investors, the interest rate is lower than it is for private investors because you are better off dealing with institutions than private entities because of the risk factor attached to private dealers. The beta coefficient isn't the only risk measurement in CAPEM because it only reflects the ratio between a given security's return volatility and market return volatility. All right. So beta is not the only risk. Beta actually is the systematic risk, but we have also the business risk that we look at, which have to be considered if you have to come up with the optimal resolutions on which projects to select. And then empirical studies have shown that the return on security does not follow any normal distribution function. returns are supposed to the assumptions of CAPM. There's the normal distribution of returns, but in a real situation, that may not happen. Returns keep on fluctuating. Sometimes you may get losses, and sometimes you may make returns. Sometimes they can be huge returns. Sometimes they can be minimal returns. So all these situations are challenged on these grounds to point out the limitations of this model. And you know very well, we cannot have a perfect model. Model is just a means of helping us managers make decisions, and they're not ends in themselves. So that's why it's advisable that whenever you're applying a certain model, try testing with other models and see the outcome. If they are behaving the same manner, then you can easily conclude to that respect. Okay, any questions? Hello? Any questions? All right, so if there are no questions, probably we'll need to stop there for today. And as we had said, next week we are embarking on presentations. So come prepared with your presentations. And as I've said, share that presentation in advance before the class so that I can also review it before the class. All right, with that, I think we stop there, and have a good evening, and see you next week. Remember the assignment 2, you can easily now work on it, and each one of you can submit once they're done, but we'll agree on when the latest you can submit your assignment so that we all moving together. Thank you and have a good evening.
ልዩነት መፍጠር ዓላማችን ነው። ዓለም አቀፍ ተወዳዳሪ መሆን አለባችሁ። የናሽናል ኤርዌይስ እህት ኩባንያ ናሽናል አቪዬሽን ኮሌጅ ጥራትና ደረጃውን የጠበቀ ስልጠና በመስጠት ብቁ ዜጋ እያፈራን ነው። በፍላይት ኦፕሬሽን፣ በበረራ መስተንግዶ፣ በቲኬቲንግና ሪዘርቬሽን፣ በሆቴልና ቱሪዝም ሙያዎች አሰልጥነን ተወዳዳሪ እናደርጎታለን። ኮሌጃችን ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና ከእንግሊዙ አይሲኤም ጋር በመተባበር ዓለም አቀፍ ዕውቅና ያለው ስልጠና እየሰጠ ይገኛል። በፍላይት ኦፕሬሽን፣ በበረራ መስተንግዶ የምንሰጣቸው ስልጠና ከኢትዮጵያ ሲቪል አቪዬሽን ባለስልጣን ሙሉ ዕውቅና አለው። አድራሻ ከጎላጉል ታወር 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ የናሽናል ኤርዌይስ እህት ኩባንያ ናሽናል አቪዬሽን ኮሌጅ ህልሞን እውን ያደርጋል።